Welcome to The Explainer. Today, we're demystifying some of that intimidating Wall Street jargon by taking one of the market's most talked about tech companies and putting it through a grueling 4-stage financial obstacle course. We are looking at Palantir, ticker symbol PLTR. We're going to strip away the hype, completely ignore the rumors, and focus purely on the math using a very strict quantitative audit.
So, here is our roadmap. We'll set up the obstacle course rules, head to Gate 1 for a liquidity check, hit Gate 2 to measure real growth, try to survive the hype trap at Gate 3, push through a financial stress test at Gate 4, and then we'll deliver the final verdict.
All right, let's jump right into Section 1. The obstacle course begins. We are treating this quantitative analysis like a strict, multi-level security protocol. And we're going to translate these complex financial metrics into everyday concepts you can easily grasp. Basically, we're testing everything from how easy the stock is to actually trade to whether its business growth is genuine. Then we'll check if the market's expectations are dangerously high. And finally, see if the company can survive extreme market pressure. To get approved, a stock has to survive every single stage. Moving on to Section 2, Gate 1, the liquidity check.
To really understand why this first gate matters so much, imagine you're trying to sell an apple. If you're at a bustling, busy farmer's market packed with thousands of shoppers, you're going to find a buyer instantly at a fair price. But if you're sitting in an empty stand in the middle of a desert, well, you're stuck holding that apple no matter how good it is. In the stock market, it's the exact same concept. You literally never want to be stuck at the empty desert stand. In finance, the size and activity of that market is measured by average daily volume, or ADV. This is simply the total dollar amount of shares changing hands every single day. For a stock to even be considered in our protocol, we require a strict minimum of $50 million a day in volume. This just ensures we aren't getting trapped.
So how does Palantir do here? Well, Palantir absolutely breezes through Gate 1. They're doing roughly $2.4 billion in daily volume, trading around 19 million shares a day at roughly $126 a share. It easily passes the institutional liquidity test. The farmer's market is packed, and trading PLTR is completely seamless.
That brings us to Section 3, Gate 2, real growth.
Think about it like this. Honestly, any business can run a flashy ad campaign and hook a one-time buyer. But that buyer might never return. The true test of a quality business, the real indicator of success, is if your existing customers love your product so much that they keep coming back and actually increase their spending with you year after year.
Wall Street calls this kind of fierce loyalty net dollar retention. So what does that actually mean? It tracks how much of your revenue growth is coming from the exact same customers upgrading or expanding their current contracts. It completely strips away the marketing noise and separates the real, sticky businesses from the empty hype.
Get this, Palantir boasts an absolutely incredible 150% net dollar retention rate. This is huge. It proves their existing clients aren't just sticking around, they are massively scaling up their usage of Palantir software. It completely validates that they have a product delivering serious real-world value. And when you pair that fierce customer loyalty with brand new sales, the results are explosive. Our protocol demands a minimum of 15% growth. Palantir? They reported a staggering 85% year-over-year revenue growth in Q1 of 2026, with 71% growth expected for the full year. PLTR absolutely crushes our minimum threshold here and easily clears Gate 2, backed up by consistent GAAP profitability.
Next up, Section 4, Gate 3, the hype trap.
Let's pivot to another analogy. If you buy normal, cheap concert tickets, you're probably going to forgive a few microphone glitches or a slightly short set list, right? You didn't pay much, so your expectations are pretty low. But if you pay massive, hyped-up premiums for front-row VIP seats, that concert better be flawless. Because if there's even one minor technical issue, you are going to demand a refund.
In the stock market, this VIP premium is measured by the PE ratio, or price to earnings. It tells us exactly how much money investors are willing to pay today for just a single dollar of the company's current profit. Essentially, it's a gauge of how much future expectation the market has already baked right into the current stock price.
And here is where we hit a speed bump. Palantir has a sky-high PE ratio of roughly 142x. Investors are literally paying $142 today for every $1 of earnings. This clearly shows the market is aggressively pricing in their massive AI adoption. People are buying those front-row VIP tickets, and they are expecting an absolute masterpiece.
Which naturally brings up a really critical question. Is the stock priced for absolute perfection?
This sky-high valuation throws a massive yellow caution flag at gate 3. It really forces us to ask if there's any room for error or if the stock has just gotten way ahead of itself. Honestly, this dynamic explains why the stock saw a 3.3% drop today despite having such strong fundamentals.
Our source material really hits the nail on the head here, noting that any slip in U.S. commercial revenue growth or contract renewal rates would lead to immediate multiple compression. In plain English, because expectations are set at literal perfection, even a tiny stumble in contract renewals would cause investors to panic, resulting in the stock price dropping sharply. So yes, it passes the business quality checks, but the hype trap is very, very real.
Now for Section 5, Gate 4, the stress test.
When economic times get tough, we need to know exactly what kind of financial house the company lives in. Is it a self-sustaining house with its own solar panels that generates its own energy? Or is it a total money pit that constantly needs you to take out loans just to keep the lights on?
We check this by looking at capital expenditures versus free cash flow. This reveals the actual hard cash a company puts in the bank after covering all its operational costs and infrastructure investments. It tells us point blank if a company is truly a self-sustaining solar house or if it's just a money pit burning through cash to fake its growth.
Well, Palantir passes this stress test with flying colors. I mean, they are projecting a massive $4.2 to $4.4 billion in free cash flow for 2026. They absolutely aren't burning cash to grow. Plus, their revenue is safely diversified across steady government contracts and fast-growing commercial sectors. This acts as a really powerful hedge, making them incredibly resilient compared to earlier-stage AI firms that are just bleeding money left and right.
And finally, Section 6, the final verdict.
Palantir ran the gauntlet. It easily survived checks for liquidity, it proved its real-world growth, and it completely aced the stress test. But it definitely stumbled at Gate 3 with that perfection-priced valuation. Because of this, the model verdict gives Palantir a conditional pass, categorizing it as a speculative buy or watch. Right now, the stock is sitting at $126.35. The mathematical target suggests waiting for a consolidation in the $120 to $125 range to ensure you get a safer risk-adjusted entry. So I'll leave you with this final thought. Now that you know the math, will you let FOMO drive your investments, or will you have the discipline to let the stock come down to your target?